On this Lunch and Learn, we're looking at implementing the ILR, the Interest Limitation Rule. My name is Gareth Bryan, I'm a tax partner with KPMG, and today with my colleagues Emily Lawler, Graham Thompson and Karen Carthy, we're going to be doing a recap of the rules. Then we're looking at some practical examples that may be relevant when you're considering your ILR position, and then we're going to talk about some of the practical administrative issues that are likely to come up when you start looking at your corporation tax return. Let's start with that recap. As you will probably know, ILR applies to restrict a company's tax deductions for interest expense at 30% of its EBITDA. But it's not just interest that's caught. Things that are considered economically equivalent to interest are also caught by the rules. You'll see these listed on the left side of the slide. They include things like the finance element of finance lease rentals, or derivatives that are connected to debt. So for example, an interest rate swap, the payments under that will also be considered interest equivalents for the purposes of these rules. Similarly, foreign currency derivatives that are hedging debt will also be caught to the extent they are hedging the interest component. There's also an important catch-all category, things that are reasonably considered to be economically equivalent to interest, and Revenue have published some useful guidance on things that might fall into that category. It's important to bear in mind that the rules apply to the net interest expense of a company. That means you need to identify both deductible interest expenses as well as taxable interest equivalent income. There is an important exception for legacy debt. That's debt where the terms were agreed before 17 June 2016. This can be an important exception and is worth considering when you're looking at your corporation tax position for your company. When you've identified both your net interest expense and expense equivalents and your taxable interest income and income equivalents, you'll either have a net expense, that is an exceeding borrowing cost to which a restriction could apply, or potentially your interest equivalent income might be greater than your expenses. Then you'll have interest spare capacity, which is something you can carry forward and use in future years. We'll come back to that a little later. It's important to bear in mind that there are two important exemptions which could apply and are relevant to companies. Firstly, there's an exemption for standalone companies. These are companies that are not part of a consolidated worldwide group, have no 25% plus associates, such as shareholders, and have no foreign branches or permanent establishments. The logic behind this exemption is that essentially third-party debt should not be restricted. As such, companies with these attributes are considered to only have third-party debt and therefore should not be subject to any ILR restriction. The other exemption is the de minimis exemption, which says that if a company has no more than euro 3 million of a net interest expense in a given year, it should not be subject to ILR at all. It's important to bear in mind that this is a cliff edge exemption. Even a single euro in excess of this amount means the full amount of your interest expense can be subject to restriction. Having looked at what your interest equivalent expense and income is, it's now time to work out what your EBITDA is, and this is measured under your tax principles. Therefore, what you're starting with, the relevant profit on this slide, is actually a computation of your taxable profit using all the normal corporation tax rules. To this, you add back your net interest equivalent, which we've just talked about, and also any legacy debt that you excluded from that net interest equivalent. The depreciation is essentially your tax depreciation, so capital allowances and balancing charges, and you also have to add back any foreign tax that you've deducted. As I've said, the relevant profit is essentially your taxable profit, but it does need to be adjusted for certain items. Losses carried forward or brought back that relieve the company's profits for that year have to be excluded, as do most forms of group relief, though not interest as a charge, because that is treated as an interest expense of the claimant company. There is an important exception that you exclude from EBITDA, and that's in respect of interest on income on qualifying long-term infrastructure projects. Long-term infrastructure projects are ones that are based in the EU with an EU operator and which fall into one of a number of designated categories that are set out in the legislation. Generally, they include things such as energy generation, such as coal, oil, gas, thermal and renewable energy generation, certain transmission networks, rail works, motorways, and certain strategic housing developments. If you're involved in any of these areas, it's worth carefully considering whether or not you can qualify for this exclusion. Having worked out both your net interest equivalent and your EBITDA, you now apply the restriction. Essentially, does your net interest equivalent exceed 30% of your EBITDA? If it does, you have to adjust your tax computation to disallow the excess amount. Taxpayers have their own choice as to where they want to allocate that disallowed amount. So a company which is carrying on, say, a rental activity and a trading activity with interest expense funding both of those can decide how it wants to allocate the disallowed amount. In order to ensure parity between different types of activities that are taxed at different rates, there is a scaling adjustment which needs to be applied to any income or gains that are not taxed at the 12.5% rate of corporation tax. Essentially, these amounts are regrossed so that if they were taxed at the 12.5% rate, you would get the same tax bill as they actually have applying the 25% rate in the case of passive income or 33% in the case of capital gains. So, for example, a Case 5 rental company will double all of its income because that's 12.5% by 2 to get to its 25% rate. Equally, it must double its interest expense in applying these rules. Where there is a disallowed amount, the company can carry that forward and use it in future years where its interest expense does not exceed 30% of EBITDA in that year. This can be used against any of its future years' activities. There is an important exception, and that is where the disallowed amount would have created or increased a tax loss if ILR did not apply. In those cases, the disallowed amount is reclassed as a loss and is carried forward as a loss that can only be used in future years when the company has sufficient capacity. That is, it has not exceeded its 30% of EBITDA in the year when it uses that loss. This is an important restriction because losses are streamed, so trading losses can only be used against trading income and Case 5 losses can only be used against Case 5 income. Therefore, where you're carrying forward a disallowed amount as a loss, it is far more restrictive than subject to the normal rules. If a company does not exceed the 30% of EBITDA limit in a given year, it'll have spare capacity, and it can carry that forward to future years along with its interest spare capacity, which we mentioned earlier, such that if in future years it exceeds its 30% limit, it can use this spare capacity as a top-up so that it can reduce any restriction in those future years. It's important to bear in mind that this spare capacity that's carried forward is subject to a 60-month life. That is, it would lapse after 5 years. We're now going to consider two reliefs that are available in respect of worldwide groups. Where an Irish company is a member of a worldwide group, it has access to certain reliefs and exemptions. A worldwide group is one where there is line-by-line accounting consolidation of its members, but only where they are consolidated under certain recognised, generally accepted accounting practices. These are listed on the screen. They include IFRS and Irish GAAP. Where a company is a member of a worldwide group, it is able to access, potentially, the group ratio relief or the equity ratio exemption. Again, these principles link back to what we talked about in respect of standalone entities. Essentially the idea that third-party debt should not be subject to restriction. However, because it would be possible to disproportionately allocate third-party debt to a particular company or indeed a particular jurisdiction, the rules don't simply say that interest on third-party debt is excluded. Instead, they seek to allocate that debt on a proportionate basis between the group members and potentially allow for relief or exemption on that basis. The first relief is the group ratio relief. It looks at the worldwide accounting consolidated results for the group, and applying the accounting results, it looks at what percentage of the accounting EBITDA is accounted for by means of finance expense, interest essentially. If that percentage is more than the 30% normal limit, then the group can apply that higher percentage when applying its ILR calculations. Importantly, these measures of EBITDA and of financing expense are those recorded in the company's financial statements and are not linked to the earlier definitions of interest expense that we use when looking at the tax rules. So there can be an important difference here. The second relief is the equity ratio exemption. Essentially, this looks at the group's balance sheet and the company's balance sheet and the relative levels of equity capitalisation. For both the group and the company, you look at the equity to total assets ratio, and this tells you how heavily equity capitalised the group is, and if the Irish company concerned has at least as good or better equity capitalisation, then there cannot have been disproportionate allocation of third-party debt to it, and the rule provides there should be full exemption from ILR in those circumstances. Indeed, there's even a degree of leeway. The Irish entity can have 2% worse position than the group and still qualify for full exemption. Importantly, the equity ratio must be done looking at the balance sheets under the worldwide group GAAP results. Therefore, if you had an Irish company that prepared its financial results under, say, IFRS, but the worldwide group was preparing its results under US GAAP, you would need to convert the IFRS balance sheet of the company to US GAAP when doing this calculation. It's worth also briefly mentioning a third category That is, companies that are not standalone entities because perhaps they have a 30% shareholder, for example, but are not consolidated on a line-by-line basis into a worldwide group. In order to make sure that these companies are not unfairly treated, they are given a form of access to both the group ratio and the equity ratio. Essentially, that company can compare its own single entity results to that of a notional worldwide accounting group, of which it is the only member. But those notional worldwide results have to be modified. And essentially, any debt with an associated enterprise, for example, a 30% shareholder, is reclassified as equity. This means that the notional group accounts have a higher equity capitalization if there is any debt with an associated enterprise, making it more difficult for the single company worldwide group to qualify for relief under either the equity ratio or the group ratio. We're now going to have a look at interest groups. The legislation provides that companies can elect to form an interest group, and when they do so, the ILR calculations are done on a group basis, and they are to comprise all the results of the group members. These results, Revenue confirm, can be done on an aggregation basis or consolidation basis. That is, you can eliminate intra-group transactions such that they are consolidation adjustments like you would have in a set of consolidated financial statements. Where you have an interest group, the group can decide how to allocate any disallowed amounts between the group members. Alternatively, the group can look at spare capacity that some group members may have and reallocate that across the group to companies that might otherwise have a restriction. If the companies wish to pay each other for the use of these attributes, then they can do so without any tax effect arising. Group membership is something that must be elected into for 3 years. Therefore, careful consideration should be given to whether or not it makes sense to elect in, given that a company must stay in then for 3 years, so long as it meets the conditions to be in the group in the first place. Those conditions are that the company has to be part of the same worldwide group, that is, consolidated line by line under one of those relevant gaps, or in the same corporation tax loss group. If you are considering forming an interest group, it is worth bearing in mind how this position might interact with the various reliefs and exemptions that are available. There is a €3 million de minimis exemption that can apply to each individual Irish company in a group. But if an interest group is formed comprising those members, that €3 million de minimis is applied to the group as a whole. So, if there were 4 companies that elected into a group, they do not get a €12 million de minimis exemption. The €3 million limit applies to the group as a whole. In addition, when it comes to the group ratio and the equity ratio, they are to be considered at the group level. And this means for the equity ratio, it is necessary to have a set of consolidated financial statements which include all of the members of the interest group. Many Irish subgroups of international groups will have their own set of local consolidated results, and these could be used for that purpose. However, care will be needed if there are any entities that are part of that line-by-line consolidation that are not members of the interest group, for example, a foreign subsidiary. If such an entity is included in the line-by-line consolidation, the consolidated results will need to be amended such that that line-by-line consolidation is removed and instead that subsidiary is treated like an investment on the balance sheet. This can require substantial additional accounting work and should be borne in mind before any decision to form an interest group is made. I'm now going to hand over to Emily and Graham, who are going to look at a number of practical examples of the ILR and how it might impact you when you look at your corporation tax position.
Thanks, Gareth. This example illustrates how to calculate the interest equivalent of a finance lease payment under the ILR legislation. As you already know, a finance lease will generally have an appendix or schedule of payments detailing the breakdown of a finance lease payment between the interest component and capital component over the life of a finance lease. And from an accounting perspective, the interest component and capital components will be recognised in the income statement and balance sheet respectively. Therefore, you might expect that it should simply be the case of taking this interest amount as the interest amount to be used in the ILR calculation. However, this is not the case, as there is a separate calculation that needs to be performed to determine the amount of interest to be taken as the interest equivalent of a finance lease. The formula is noted on the slide, i.e. the P by A over B formula, P being the taxable or deductible lease payment in a given year, A being the expected finance income or cost recognised in the accounts under GAAP over its life, and B being the expected total cost or income of the lease over the life of the lease. In this example, it is assumed that the asset cost for lessee is 1.2 million, with the principal component of the finance lease being $200,000 per annum over 6 years and an annual interest rate of 5%, giving an interest rate of $60,000 in year 1, $50,000 in year 2, and so on, to give a total amount of interest of $210,000 over the life of the lease. Now, this represents the A amount in the formula, and the next step is to recognise the B amount of the formula, which is a totality of $1,410,000, and you divide A by B to get a percentage of 15%. The 15% is then multiplied by the P element, which is the deductible lease payments amount in each year. Now, it's important to note that in this example, we're assuming that the lessee is not making a Section 299 election to claim tax depreciation on the asset. Therefore, the tax deductible lease payment is being assumed to be the amount of $260,000 in year 1, being from an accounting perspective the capital component of $200,000 and the interest component of $60,000. This is applying the principles of Section 81 to allow a full deduction for the capital element and interest element on the basis that the $260,000 represents a disbursement or expense incurred wholly and exclusively for the purposes of the lessee's trade. Therefore, the interest equivalent in year 1 is determined by multiplying the 15% by $260,000 to give an interest equivalent of $39,000. You will note that this amount is less than the $60,000 being the amount recognised from an accounting perspective in that year, and therefore this is a good thing in year 1, as there is less amount of interest equivalent to potentially be restricted in year 1. However, this position will reverse over the life of the lease, such that more interest expense will be recognised for ILR purposes than is being recognised in the accounts. For example, in year 6, the accounting interest will be $10,000, whereas the ILR interest will be $31,500. Contrast this example where a lessee is making a Section 299 election such that the capital components of the finance lease is instead being claimed as tax depreciation rather than a deductible lease payment. This would result in the P element in the example on screen in year 1 being reduced to $60,000 from $260,000, and multiplying this $60,000 by 15% to produce a much lower interest equivalent. You are effectively calculating a fraction of a fraction. This is likely an unintended consequences under the Irish tax legislation. This is beneficial from a lessee's perspective, as there's less amount of interest for ILR purposes, but would not be as favourable from a lessor's perspective, as less interest income is being recognised for ILR purposes. So in summary, it is just to be aware that there are calculations to be performed to calculate the interest component of a finance lease, and it can result in some unusual outcomes. Emily.
This next slide addresses how certain types of financing costs may be considered interest equivalent. Here we consider certain types of fees, foreign exchange and derivative amounts, and other amounts that may contain an interest and principal element. The definition of interest equivalent for ILR purposes includes amounts arising directly in connection with raising finance, including guarantee fees, arrangement fees, and commitment fees. Revenue guidance specifically includes examples in relation to arrangement fees and guarantee fees. It also provides that in determining whether fees will be considered interest, fees that are directly connected with raising finance will be considered interest equivalent, for example, a fee paid in exchange for a bank guarantee. But fees that are not directly connected with raising finance, such as valuation fees, legal fees, or registration expenses in acquiring a property, for example, will not be considered interest equivalent. Foreign exchange gains and losses on interest, or amounts economically equivalent to interest, are also in scope of ILR, as well as amounts under derivative instruments, hedging arrangements, to the extent that they are directly connected with raising finance. Any foreign exchange movements must be split between the portion that is referable to the principal and the portion that is referable to interest. The portion that relates to the interest element should be considered interest equivalent. In the context of derivatives, if, for example, two companies enter into a swap arrangement, the interest payment and the swap payment will be considered deductible interest equivalent, and the swap receipt will be considered taxable interest equivalent, and so would be included in calculating net interest equivalent. The term interest equivalent is not exhaustive and specifically includes any amount arising from an arrangement or part of an arrangement which could reasonably be considered to be economically equivalent to interest. Therefore, consideration should be given to matters such as debt forgiveness, for example, if the amount written off to the income statement contains any element of interest or interest equivalent, which is considered either deductible interest equivalent or taxable interest equivalent, it should be included in calculating net interest equivalent. A similar approach should also be taken in relation to revaluation gains on debt or gains on limited recourse financing to determine whether any element could be considered interest or interest equivalent. Moving on to the next slide, consideration must also be given to items of interest or interest equivalent that may be hidden or included in other charges booked to the income statement. For example, where interest or interest equivalent on borrowings used to acquire an asset is capitalised to the cost of that asset and is subsequently amortised through the income statement. These amounts need to be identified and included in calculating net interest equivalent. If interest is capitalised to an asset on which capital allowances are claimed, the interest element included in the allowances claim must be identified and split out from the allowance referable to the cost of the asset. On this slide, you can see the formula for calculating EBITDA, which Gareth mentioned earlier. In calculating EBITDA, any capital allowances or balancing charges are to be reversed, but any amount of such an allowance or charge referable to deductible interest equivalent should be excluded, as otherwise these amounts would be double counted, as they will already be captured in the net interest equivalent part of the calculation, being I in the EBITDA formula. So the key takeaway here is that there could be elements of interest or interest equivalent buried within other items contained within the financial statements that may require evaluation.
You may be aware that there are certain group reliefs available to mitigate the interest restriction applying to an Irish company or an Irish interest group, such as the group ratio or equity ratio. Before considering whether such reliefs may apply, it is necessary to first identify the ultimate parent company to identify the applicable worldwide group. Section 835AY of the Irish tax legislation defines an ultimate parent as an entity that prepares consolidated FS under generally accepted accounting practice, or GAAP, or an alternative body of accounting standards, and whose results are not consolidated elsewhere. GAAP is defined on screen with the definition applying from Section 4 of the TCA, and essentially means a company that prepares FS under IAS, or if not IAS, Irish GAAP. An alternative body of accounting standards is also defined on screen with the definition applying from Section 835AY and includes standards in Australia, Canada, Hong Kong, Japan, New Zealand, Singapore, the Republic of Korea, the USA, India and China. Therefore, taking the example on screen, you will note that there are two levels of accounting consolidation, being an IFRS consolidation between OpCo and HoldCo and a Lux GAAP consolidation between LuxCo and HoldCo and OpCo. You might expect that the ultimate parent company for the worldwide group would be LuxCo. However, unusually, Luxembourg GAAP is not listed as an alternative body of accounting standards and is equally not a GAAP for ILR purposes, and therefore the worldwide group does not include LuxCo. Therefore, HoldCo is the ultimate parent company and its worldwide group is the IFRS consolidation between HoldCo and OpCo. Contrast this example with a scenario where you may be looking to rely on the single company worldwide group, which is another form of group relief. By way of reminder, a single company worldwide group is a company that is not a member of a worldwide group, which is with reference to consolidation as just demonstrated, is not a member of an Irish interest group, if an Irish company elects to be part of such an interest group, and is not a standalone entity, which is effectively any company that is a member of a worldwide group and has no associated enterprises. Therefore, a single company worldwide group will have associated enterprises, and that test is also with reference to consolidation, like our example on screen. But unlike our example on screen, association also includes any shareholder owning 25% ownership or voting rights in the company, or any company that has significant influence over the company, which is an IFRS concept with reference to participation in board activity and policy decision making. So in summary, identifying the applicable worldwide group is fundamental when seeking to apply a form of group relief and is not as straightforward as you might expect.
So this next example illustrates a situation where a Case 5 rental company has an ILR restriction and how this can be utilised in a single company context and how relief may be available in an interest group context. Here, PropCo is a Case 5 rental company which owns an investment property. HoldCo is the parent company of PropCo. As you can see from the computation on the slide, PropCo has an EBITDA of 100, so our ILR cap at 30% is 30. As the interest expense arising for the year is 140, there is a disallowable amount of 110. When preparing PropCo's tax computation before any ILR adjustments, it has a tax adjusted loss of 40, which we can see is driven by its interest expense. When preparing PropCo's revised tax computation to take into account the disallowable amount which is added back, the taxable profit is now 70. While the revised computation results in taxable profits, meaning the PropCo will now pay tax where it would not have otherwise, but for the ILR restriction, this amount is available to carry forward to succeeding accounting periods and is referred to as the deemed borrowing cost. As PropCo has had a Case 5 loss of 40, PropCo's total disallowable amount of 110 is split into two amounts, the deemed borrowing costs of 70 and the Case 5 loss of 40. Propco's Case 5 loss of 40 is only available for Propco to carry forward to offset against future Case 5 profits. However, the deemed borrowing cost of 70 can be used differently. Because Propco has moved from a position where it incurred a tax-adjusted Case 5 loss to a position where it has taxable profits when the disallowable amount is added back, it is therefore required to pay tax where it would have had no liability had there been no disallowable amount. As Propco has to pay more tax in the current year, it can carry forward the deemed borrowing cost of 70 and deduct this amount from its total profits or chargeable gains in a subsequent accounting period. This is subject to Propco having sufficient spare capacity in the subsequent year, meaning the maximum deemed borrowing cost deduction available to Propco in a given year is limited to Propco's total spare capacity for that year, with any excess carry forward. To the extent that Holdco has any spare capacity rising, it could form an interest group with Propco, so that Propco could claim some spare capacity from Holdco. This could happen if, for example, Holdco disposes of shares in a subsidiary and a gain arises on the disposal, meaning it should have limitation spare capacity, which broadly speaking would be 30% of its EBITDA, assuming Holdco has no deductible or taxable interest equivalent. Assuming that any gain arising for Holdco would be taxable at 33%, the gain would need to be grossed up so that it gives the same result were the amount taxable at 12.5%. Similarly, as Propco is subject to the 25% rate as a rental company, it would need to regross its relevant profits and interest to have comparable values. So in summary, Propco has a disallowable amount which it can carry forward to subsequent accounting periods, or it could form an interest group with Holdco to the extent that Holdco has spare capacity.
This slide illustrates the operation of the group ratio and equity ratio. The group ratio means the percentage obtained after dividing the group exceeding borrowing costs or group net financing expense by the group EBITDA. The group net financing expense is shown on screen and is obtained by the addition of the total deposit interest of 500k and the interest expense of 19 million to give a result of 18.5 million. The group EBITDA is obtained by adding the PBT of 17.5 million with the interest expense of 19.5 million, depreciation of 18 million and the deposit interest of 500k to give a result of 54 million. The group ratio is then obtained by dividing the 18.5 million by 54 million to give a result of 34.3%. A company would ordinarily be restricted to an interest deduction of an amount not to exceed the EBITDA limit being 30% multiplied by tax adjusted EBITDA. However, the group relief provided under the group ratio effectively allows a company to replace the company EBITDA limit of 30% by the group ratio, which effectively means you get an uplift of 4.3% in this example as the group ratio is 34.3%. In contrast, the equity ratio provides for full relief from an ILR restriction and compares the company's ratio of equity, being your share capital, share premium and reserves, to total assets with the group's ratio of equity to total assets. Provided the company's ratio of equity to total assets is greater than, equal to, or not more than 2% less than the worldwide group's ratio of equity to total assets, no ILR restrictions should apply. As you will note in the example on screen, the company's equity to total assets is 60.9%, which is greater than the group equity to total assets of 55.3%, and therefore the equity ratio should apply and no ILR restrictions should arise. It is important to note, to apply the equity ratio, it is necessary for the balance sheet of the company to be prepared under the same accounting standards that apply to the worldwide group. Therefore, to the extent that the ultimate parent prepares a statutory FS under, for say, IFRS, but the company prepares a statutory FS under Irish GAAP, a notional balance sheet of the company would have to be prepared under IFRS in order to determine if the equity ratio group relief could apply. Therefore, early interaction with your finance teams will be important if you're seeking to rely on the equity ratio, and particularly where revised balance sheets are needed due to divergence in accounting standards used by a company and its ultimate parent. This next example is a nice segue from the previous example as it considers the application of an Irish interest group and the equity ratio. On the left of the slide, you will note that the Irish companies in green are part of a local accounting consolidated group, but also have elected to be treated as an Irish interest group for the purpose of ILR. Therefore, the Irish interest group's ratio of equity to total assets is compared with its worldwide group at the level of worldwide holdco to consider if the equity ratio may provide for full group relief. This may be a relatively straightforward calculation to perform, particularly if the accounting standards of the local accounting consolidated group are the same as the standards of the worldwide holdco, noting our example on the previous slide. Contrast this with the example on the right of the slide, which illustrates that there is a local accounting consolidated group which includes a non-Irish company, and that non-Irish company cannot form part of an Irish interest group. Therefore, a notional balance sheet would be needed for the Irish interest group i.e. excluding your UK servicing company, in order to compare its equity ratio to the worldwide group. Essentially, it would not be as straightforward as the example on the left, where the accounts of the Irish interest group and the local consolidating group would be the same. It is also important to note that to the extent that any Irish companies do not elect to be part of an Irish interest group, they will be treated similarly to UK Service Co, and its results would need to be excluded from the interest group in order to compare the Irish interest group with the worldwide group. Again, this demonstrates the importance of early interaction with your finance teams, where you're seeking to rely on the equity ratio under an Irish interest group. Now I'll pass you over to Karen.
Over recent years, the corporation tax return has been growing in length and in complexity. The 2022 corporation tax return continues with this trend and includes no less than 3 pages of ILR-related disclosures. The level of disclosures applicable to each entity will depend upon the specific facts applicable to that entity, and there are a mixture of both mandatory and optional disclosures within the return. Just to note, the corporation tax return includes a box to tick to indicate if the return relates to a period commencing prior to 1 Jan 2022, meaning that the return for that period is out of scope of ILR and there's no need to complete any of the ILR related disclosures. Mandatory disclosures are one which every entity is required to complete. These questions are yes or no tick the box type questions. The mandatory disclosures that every entity is required to complete are whether it is a standalone company, whether it is part of an interest group, and if it is, then the name and tax reference number of the reporting company will need to be disclosed. Also, whether it is carrying on any long-term public infrastructure projects, and if yes, then details of the income, expenses, and net interest expense directly connected with such projects will need to be disclosed. Other disclosures that an entity may need to include on its corporation tax return could include details of the component parts of its ILR calculation. So for example, where an ILR calculation has been completed and a restriction applies, then the entity is required to disclose certain details in relation to that calculation, such as its EBITDA, the allowable amount, the disallowable amount. An entity will be required to disclose where it is relying on the de minimis exemption. This again is a tick the box disclosure, so no numbers are required to be disclosed. Where an entity is relying on the equity ratio or the group ratio, then it will be required to outline details of the exemption calculation, such as the equity and total assets of the company and of the worldwide group. If an entity is the group remitter for an interest group, then it will be required to disclose information in relation to all entities that are part of the interest group. So this means that the corporation tax return of the individual group members may be very light by way of disclosures, as almost all information will be included on the corporation tax return of the reporting entity. This will obviously mean that the group remitter will need access to a lot of data and information about every company within the ILR group. Information to be disclosed includes the name and CT reference number of every member of the group, also each group member's disallowable interest, spare capacity in the period, spare capacity reallocated to other group members, as well as more computational information for each group member. As I mentioned earlier, there are some optional disclosures on the return, such as deemed borrowing costs carried forward or utilised in the period, and total spare capacity carried forward or utilised in the period. What we are seeing in practice in relation to these optional disclosures is that companies are taking a practical view and weighing up the time and cost needed to quantify these amounts against the likelihood of them being utilised in the future, and then deciding whether to populate these disclosures or leave them blank. Finally, before I hand back to Gareth for a brief wrap-up, just wanted to mention that there are special preliminary tax payment rules in place for companies that miss their preliminary tax payment obligation as a result of the impact of ILR on their corporation tax liability. In summary, where a company has underpaid its preliminary tax as a result of the impact of ILR, then it is allowed to make a top-up payment of tax up to 6 months after its year end. This rule remains in place for accounting periods ending on or before 31 December 2027.
So let's wrap up. Firstly, other than for the simplest of companies, you're likely going to need to do some form of modelling to figure out whether or not you may have an ILR restriction, even if it's just on the back of an envelope. Doing that will require you to consider and apply the basics that we've outlined in our presentation today, as well as some of the more detailed rules, such as whether or not you should join an interest group. It's important to remember that determining what is interest or an interest equivalent is not straightforward, and you may find that there are elements hidden inside other components of your financial results. You should review carefully your accounts position, and if you're going to rely on the equity ratio or the group ratio, consider the accounts consolidation position for your group. The legacy debt exclusion is a valuable one for many groups, so you should carefully consider whether or not you can qualify. Where there are items that are uncertain, consider whether or not the revenue guidance might indicate revenue's view on those elements. And finally, you should carefully prepare for the upcoming compliance burden and all of the disclosures you may have to make in your tax return. In conclusion, I'd encourage you to contact your KPMG client service team to see how we can help you with your ILR analysis. Thank you.